when I think about accounting, right, it starts with the basics, which is literally taking paperwork and putting it into a system, right? That's like the basics. So we call that bookkeeping. So this is somebody who's tracking your records, right? And tracking the documents, and you have to have then somebody who checks the bookkeeper, right? So this is somebody who's like, okay, so is the bookkeeper doing their job? And what the bookkeeper says, is it tying out to what the bank says? So we call that reconciliation. So it's like, oh yeah, so here's the, in my case, here's my retirement account. I would record the value of this document, right? So that's the bookkeeper. And then the reconciler comes in and goes, yeah, that matches. This matches what the bookkeeper says. That's reconciliation. And then the next step is the accountant who comes in and the reconciliation process verifies what the bookkeeper has done. And then they typically provide like a report, like they'll write up and they'll say, oh, okay, so Dr. Devia, we've calculated and analyzed your financials, and we see that you had a 4% growth over the last quarter. You know, what was some of the reasons why? And then you'd say why, you know, whatever. And they would say, oh, Dr. Devia, you're spending 52% in labor. The national average is 42%. So we've got to cut some costs. So let's go look at your labor costs. Is running those analyses for you, right? They're telling you, hey, listen, based on your industry, this is what the average is, and you're performing either at or below the industry mark. So you can make your adjustments. Or, you know, we look at costs. We look at, if you were, for example, I have clients in the restaurant industry. We look at turnover rates. So we look to see which products are selling the fastest, right? So my clients, we discovered that one of their boba teas that they produce is the biggest moneymaker because it flips really fast because it's popular. So then we figure out a pricing structure behind it to increase the revenue. So that's the accountant's job. The accountant's job is to analyze the numbers and to give you some feedback on that. And again, to say to the world, you can rely on these numbers to make financial decisions. If you're an investor and you want to invest in Dr. Devia's business, you can rely on these numbers that you're going to make money if you invest in her company. And I'm giving you that guarantee. I'm telling you this because I'm the expert in this field, right? So that's what the accountant does. Now that stops right there. No more, the end, done, move on. Tax preparer is somebody who takes the financial data from the accountant's reports, the balance sheet, the P&L, and simply inputs the data into the tax return. So once again, it's the same thing like the bookkeeper. They're just putting in the data, just plugging in the numbers. That's it. No questions asked. They just put it in. And they're also going to ask for supporting documents in case they're missing or we need them. So they might reach out, Dr. Devia, so we noticed that you made a SEP contribution. We need the receipt because we don't see it in your paperwork. And you're like, oh, let me go to my accountant. But then your accountant goes, nope, Dr. Devia, I don't have that. Your bookkeeper has that. Right? Because the bookkeeper is the one who's tracking the receipts. So you go to the bookkeeper and then they give you it and then you give it to the preparer. So the preparer's putting it all in. Boop, 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 boop. And then from there, what happens is it then gets basically like submitted, right? It gets submitted to the government because all is said and done. And press the button and you owe tax or you don't owe tax and process it and call it a day. Tax advisory or tax strategy, right? And that's what the world I play in. And I'm like the accountant in that regards, because I'm looking at it from a 5,000-foot view, and I'm also coming at you and giving you advice. So, Dr. Devia, I noticed that you overpaid $12,000 in tax. You know, what we can do is we can, and we're going to assume that you're paying for this service, for example. So it'd say, oh, so you know what we're going to do? We're going to shift the entity type so that we can reduce the tax, or we're going to hire more people, or we're going to spend more money in this area or this area to create more wealth for you, or put it into long-term retirement accounts or whatever the case may be. So the strategist or the advisor is acting the same level as the accountants. It's the 5,000-foot view looking down to free up money. And so oftentimes